You're being sold the dream of endless sunshine, beachfront living, and tax-free retirement. But what if that dream comes with insurance premiums that triple in 30 years? Welcome to America's Climate Real Estate Reckoning, where $1.47 trillion in home values could vanish by 2055. We've uncovered cities where climate risk isn't just destroying property, it's dismantling the entire economic model that makes homeownership possible. This isn't speculation about distant hurricanes or theoretical wildfires. In 2025, 5.2 million Americans are already climate refugees, fleeing homes they can't insure, neighborhoods they can't afford, and futures that no longer exist. Before we count down the 10 cities where climate risk is eating home values alive, hit subscribe. Not for us, but because what's happening in these markets today is coming for your neighborhood tomorrow. Here's what real estate agents won't tell you. Insurance premiums are rising faster than mortgage payments. In some cities, the cost to insure your home will surpass your property tax bill within a decade. Welcome to the climate tax, a mandatory, ever-increasing charge that no calculator predicted and no appraiser disclosed. Number 10. Sacramento, California. You arrive in California's capital, expecting a break from coastal prices. Sacramento sits inland, seemingly safe from sea level rise. The median home price hovers around $525,000 expensive, but cheaper than San Francisco. Then you see the smoke. Sacramento faces a 137% insurance premium increase by 2055, driven entirely by wildfire risk. The Camp Fire, the Dixie Fire, the Caldor Fire, each one creeping closer to suburban developments marketed as safe refuges. Here's the brutal math. Today's average homeowner's insurance runs about $1,800 annually. At 137% increase, that climbs to $4,266 by 2055. One catastrophic fire season accelerates everything. After the 2025 LA wildfires that killed 28 and destroyed 16,000 structures, carriers across California are reassessing risk. Sacramento neighborhoods once considered low risk are being reclassified. The wildfire threat grows every year. Hotter temperatures, longer droughts, denser suburban development pushing into wildland zones, creating perfect conditions for catastrophe. You're buying a house in what fire experts call the red zone. Number 9. Colorado Front Range cities. Heading east to the Rockies, Colorado sold itself as climate refuge. Cool summers, 300 days of sunshine, mountain lifestyle. Denver metro median prices sit around $575,000. But 2025 revealed Colorado's perfect storm. Wildfire exposure, severe hailstorms, and skyrocketing reconstruction costs converged. Homeowners purchasing new policies paid $666 more in December 2025 than 2024, one of steepest increases nationally. The Marshall Fire in 2021 destroyed over 1,000 homes in winter, a season once considered safe. Climate change eliminated the fire-free season. Colorado became one of 3 states seeing steepest 2025 rate hikes. The average premium jumped 8.5% nationally. Colorado far exceeded that, with some zip codes seeing 15–20% increases. Roof age now dominates pricing. Homes with roofs over 10 years pay massive premiums even before wildfire exposure. The Front Range houses 5 million people in wildfire interface zones. You're buying mountain views and escalating premiums that increasingly reflect climate reality rather than lifestyle fantasy. Number 8. Houston, Texas. Welcome to Houston, where 100-year floods now happen every few years. The median home price sits around $325,000, but that affordability comes with hidden costs measured in feet of floodwater. Hurricane Harvey in 2017 dumped 60 inches of rain, causing $125 billion in damage. Then Imelda in 2019. Then the February 2021 freeze that burst pipes across the city. Then floods in 2024. The pattern isn't slowing, it's accelerating. Houston's challenge is unique. Built on flat coastal prairie with clay soil that doesn't absorb water, the city floods from rain, storm surge, and overwhelmed bayous simultaneously. Add rapid development, paving over wetlands that once absorbed floodwaters, and you've created a bathtub that fills faster each year. FEMA flood maps, already outdated, don't capture risk. Homes supposedly outside flood zones go underwater. The National Flood Insurance Program, deeply in debt, keeps raising premiums while covering less. Private flood insurance, where available, costs thousands annually. Texas saw some of steepest insurance increases in 2025, driven by hurricane exposure and regulatory environment. The state's hands-off approach to insurance regulation allows rapid rate hikes, but also carrier exits. When insurers can't charge enough to cover risk, they leave stranding homeowners. Climate projections show Houston facing more intense hurricanes and heavier rainfall events. The city's infrastructure, built for 20th century climate, can't handle 21st century reality. You're buying into a city where unprecedented flooding happens routinely. Insurance becomes unaffordable, and property values increasingly price in abandonment risk. Number 7. Phoenix, Arizona. Phoenix built an empire in the desert through sheer determination and cheap water. Now both are running out. The median home price hovers around $475,000, but that number assumes a future the data no longer supports. The immediate climate threat isn't water, it's heat. Phoenix broke temperature records in 2024 with 113 consecutive days above 100 degrees Fahrenheit and 70 days above 110 degrees Fahrenheit. Extreme heat doesn't just make life uncomfortable, it makes outdoor work impossible, spikes energy costs, and creates health emergencies. Air conditioning bills in summer routinely exceed $500 monthly. HVAC systems fail under constant strain. Pavement buckles, power grid strain. During heat waves, ambulances transport dozens daily for heat-related emergencies. But here's where climate and real estate collide. Insurance companies are watching. While Phoenix doesn't face hurricanes or wildfires like coastal cities, extreme heat creates different risks: infrastructure failure, increased liability, health costs that ripple through the economy. The broader crisis looms. Arizona's 2023 decision to halt new groundwater-dependent development in Phoenix sent shockwaves. The state admitted it doesn't have 100-year assured water supply for new growth. Existing homes remain safe, but their value depends on a thriving market with continued development that just got canceled. Phoenix's boom depended on endless expansion. When expansion stops, what happens to property values in a city where the growth story died? You're buying into a desert city where 120 degrees Fahrenheit summers may become normal, air conditioning costs, rival mortgage payments, and the government admitted future growth is impossible. Number 6. Charleston, South Carolina. Charleston charms with historic architecture, coastal beauty, and southern hospitality. The median home price sits around $525,000, but those cobblestone streets increasingly sit underwater. Sunny day flooding now happens at high tide without storms. King tides flood downtown streets monthly. Seawalls built for 20th century sea levels fail against 21st century reality. Charleston faces triple threat: sea level rise, hurricane intensification, and land subsidence. The ground is sinking. NOAA projects Charleston could see 2+ feet of additional sea level rise by 2050, a timeline that falls within typical 30-year mortgages. The insurance market is responding. Flood insurance premiums are rising as FEMA updates Risk Rating 2, which prices policies based on actual flood risk rather than outdated maps. Homes that never required flood insurance now face mandatory requirements. Premiums that cost $500 now approach $3,000, $5,000 annually. Hurricane risk compounds the problem. Charleston sits in a historically vulnerable zone. Climate change is pushing hurricanes to intensify more rapidly and dump more rain. Each storm season carries heightened risk. The city's response, building seawalls, raising streets, installing pumps, costs hundreds of millions while only buying time. You can't engineer your way out of physics. Historic charm attracts buyers, but climate reality is repricing coastal real estate. Homes in flood-prone areas see slower appreciation, longer time on market, and buyer hesitation. You're buying Charleston's past, beautiful, historic, charming, but you're paying for a future where that past slowly drowns. Number 5. New Orleans, Louisiana. New Orleans faces 196% insurance premium increase by 2055, fourth highest nationally. The average premium could jump from roughly $3,000 today to nearly $9,000 by mid-century. The city's existential crisis predates modern climate change, built below sea level in a hurricane zone on sinking land next to rising water. Katrina in 2005 proved the catastrophic potential. Ida in 2021 demonstrated nothing fundamental changed. New Orleans loses land constantly. Coastal Louisiana disappears at a football field every 100 minutes, protective wetlands that buffer storms vanishing into the Gulf. Each hurricane punches closer to the city. Insurance reflects this reality. After Katrina, private insurers fled. Louisiana Citizens, state-backed insurer of last resort, became the largest carrier, a sign of market failure. Citizens' rate increases accelerated in 2025, with more coming. Beyond hurricanes, the subsidence crisis deepens. The city sinks millimeters annually, while sea levels rise. That combination means flood risk increases even without stronger storms. Federal investment in levees provides some protection, but levees encourage development in vulnerable areas, creating more property at risk when systems fail. The median home price around $275,000 seems affordable until you add flood insurance, $2,000, $5,000, wind, hurricane insurance rising rapidly, maintenance for foundation issues from sinking, and energy costs from extreme heat, humidity. New Orleans culture, music, and food create powerful draw, but you're buying into a city literally sinking as waters rise, a mathematical equation with one inevitable outcome. Number 4. Los Angeles, California. Los Angeles, where million-dollar homes meet million-acre wildfires. The median home price flirts with $950,000. Then in January 2025, the Palisades and Eaton fires killed 28, destroyed 16,000 plus structures, and caused over $250 billion in estimated damages. Those fires weren't anomalies, they're the new normal. Climate change created year-round fire season in Southern California. The Santa Ana winds that once blew predictably now arrive violently and unexpectedly. Drought conditions that used to be cyclical are now permanent. The insurance market cracked. After years of losses, major carriers pulled back from high fire risk zip codes. State restrictions preventing adequate rate increases forced companies to choose between losing money or exiting California. Many chose exit. California Fair Plan, the insurer of last resort, exploded from niche coverage to covering $450 plus billion in exposure. That's not insurance market health, that's market failure. Post-2025 fires, insurance availability in LA's wildfire zones essentially vanished outside Fair Plan. Premiums for available coverage doubled or tripled overnight. Homes that cost $8,000 year to insure now approach $20,000. $30,000. Here's the crisis. Mortgages require insurance. No affordable insurance means no mortgage, means no buyer, means collapsing property values. Wealthy cash buyers can self-insure, but most Americans need financing. When insurance becomes unavailable or unaffordable, entire neighborhoods become unmarketable. The fires didn't destroy just structures, they destroyed the economic model underlying California real estate. You're buying into a market where one fire season can render your investment uninsurable and unsellable. Number 3. Tampa, Florida. Tampa faces 213% insurance premium increase by 2055, third highest nationally. Today's $4,000 annual premium becomes $12,500. That's $1,042 monthly just for insurance, approaching many mortgage payments. Tampa sits in what meteorologists call Hurricane Alley, vulnerable to Gulf storms that intensify rapidly. The city hasn't taken a direct major hurricane hit since 1921. That century-long gap isn't protection, it's a ticking time bomb. Climate models show warming Gulf waters, allowing hurricanes to maintain strength further north and intensify faster. Tampa's luck isn't holding, it's running out. The insurance crisis is already here. Florida insurance market chaos, carriers failing, rates soaring, Citizens property insurance exploding to 1.5 plus million policies hits Tampa especially hard. Tampa Bay's geography creates nightmare scenario. Shallow water amplifies storm surge. A Category 3 hurricane could push 15 plus feet of water into downtown, flooding hundreds of thousands of homes. That's not worst case, that's moderate scenario. Median home prices around $400,000 seem reasonable until you add insurance reality. Finding coverage outside Citizens is difficult. Those who find it pay premiums, increasing 15-20% annually. Citizens itself approved 14% maximum rate hike for 2025, with planned increases to 15% by 2026. Florida's 15-20% homeowners insurance rate, uninsured, exceeds national average, a sign of market breakdown. People are gambling, hoping no hurricane hits before they sell. New construction continues, developers building in flood zones, selling to buyers who don't understand risk. That inventory adds fuel to coming collapse. You're buying into Tampa's century of luck, betting it holds another 30 years. The math says it won't. Number 2, Jacksonville, Florida. Jacksonville faces 226% insurance premium increase by 2055, second worst nationally. Today's $3,500 premium becomes $11,400. Add flood insurance, and you're paying $15,000 plus annually just to protect a $350,000 house. Jacksonville combines every Florida problem: hurricane exposure, flood vulnerability, sea level rise, aging infrastructure, and insurance market collapse. The median home price, around $335,000, attracted families fleeing expensive coastal cities. Now they're trapped in climate crosshairs. The St. Johns River runs through Jacksonville, a slow-moving tidal river that flows north, making it uniquely vulnerable to storm surge pushing upstream. Hurricane storm surge can flood areas 20-plus miles inland. Flooding happens without hurricanes. King tides plus heavy rain regularly flood neighborhoods. Climate change is increasing rainfall intensity. Jacksonville's infrastructure, built for last century's weather, fails routinely. Insurance availability collapsed faster in Jacksonville than most Florida cities. The combination of hurricane risk, flood exposure, and aging housing stock made carriers flee. Those remaining charge premiums that make homeownership math impossible for middle-class families. Here's the hidden crisis. Jacksonville's economy depends on military presence: Naval Station, Mayport, NAS Jacksonville, and port operations. Both face climate threats, sea level rise threatening bases, hurricane risk to port infrastructure. If military adjust presence or port operations suffer, Jacksonville's economic foundation cracks. You're buying in a city where insurance costs are spiraling, climate threats intensifying, and economic fundamentals depend on institutions that may relocate as climate risks grow. Number 1, Miami, Florida. Miami faces 322% insurance, premium increase by 2055, the absolute worst in America. A $5,000 premium today becomes $21,100. That's $1,758 monthly for insurance alone. This isn't future problem, it's current crisis. Miami's median home price, around $550,000, comes with insurance premiums already approaching $7,000, $8,000 annually in flood zones. Some waterfront properties pay $15,000 plus just for insurance. Miami's existential threat is sea level rise. The city sits on porous limestone. You can't build seawalls because water seeps underneath. High tides now flood streets. Storm drains flow backward. Saltwater infiltrates drinking water supply. NOAA projects Miami could see 2+ feet of sea level rise by 2050. That puts hundreds of billions in real estate underwater, literally. Properties in flood zones become uninsurable. Properties outside current flood zones enter them as water rises. King tides, sunny day flooding, now flood Miami Beach and downtown monthly without storms. Residents need boats to reach cars. Businesses install pumps and barriers. The city spends hundreds of millions on pump stations and elevated roads infrastructure that only delays the inevitable. Hurricane risk compounds everything. Warmer Atlantic waters strengthen hurricanes. Miami sits directly in historic hurricane paths. 1. Category 4 or 5 direct hit causes catastrophic damage, measuring hundreds of billions. The insurance market has already broken. After Hurricane Ian, $113 billion damage, carriers dramatically raised rates or exited Florida entirely. Miami's zip code saw steepest increases. Finding affordable coverage is nearly impossible. Here's the death spiral. Rising premiums drive out buyers. Falling demand lowers prices. Lower prices reduce property tax revenue. Reduced revenue limits infrastructure investment. Limited investment accelerates climate impacts. Accelerated impacts raise premiums further. Miami's luxury market still functions international buyers. Paying cash don't need mortgages or insurance. But that's not sustainable housing market. That's wealthy people parking money and appreciating trophy assets while middle-class home ownership dies. Climate scientists call Miami ground zero for sea level rise in America. It's not whether Miami becomes unlivable, it's when and who gets stuck holding worthless deeds when the music stops. You're buying into a city with beautiful beaches that are vanishing, luxury condos that need boats for access, and an insurance market that's already admitted the game is over. By 2055, Miami's insurance premiums will have quadrupled. The question isn't whether values collapse, it's whether they make it to 2055 before collapsing entirely. There you have it. 10 cities, $1.47 trillion in vanishing value, and 55 million Americans projected to become climate refugees by 2055. We've seen insurance premiums that will triple, markets that have already broken, and neighborhoods where the American dream drowned in floodwaters or burned in wildfires. This isn't just Sunbelt problem. Climate risk is repricing real estate nationwide. The question isn't whether your home is vulnerable, it's how much climate risk is already baked into its value, waiting to be discovered. Subscribe to stay ahead of the collapse, because what's happening in Miami today is coming to a mortgage near you tomorrow.